Hi everyone! Welcome to our finance series. Today we're going to be talking about credit default swaps, a financial agreement that can be a little bit tricky to understand. But don't worry, we're going to break it down for you in simple terms. So, let's start with the basics. What is a credit default swap? A credit default swap is a type of financial agreement between two parties. One party, let's call them Party A, agrees to pay the other party, Party B, a certain amount of money if a third party, let's call them Party C, defaults on a loan. So, let's say Party C is a company that wants to borrow money from a bank. The bank is worried that Party C might not be able to pay back the loan, so they buy a credit default swap from Party B as a form of protection. If Party C is able to pay back the loan, nothing happens and the bank simply pays a fee for the credit default swap. But if Party C defaults on the loan, Party B will pay the bank a certain amount of money to make up for the loss. In this way, the credit default swap allows the bank to protect itself from the risk of Party C defaulting on the loan. So, why would someone buy a credit default swap? Well, it can be a way to manage risk. If you're worried that a company might default on a loan, you can buy a credit default swap to protect yourself from the potential loss. However, credit default swaps can also be used for speculative purposes, which can be risky. If you think that a company might default on a loan, you could buy a credit default swap and then profit if they do default. But if they don't default, you could end up losing money. They can be a useful tool for managing risk, but they can also be risky if used for speculative purposes. Thanks for watching, and we'll see you next time.